I want to thank you very much for coming in for this virtual investor day. We have Peter Schiff here as well, who will be speaking for about 15 to 20 minutes on a topic that's really been on his mind recently. So really excited to see and to hear from him as well. But just a shout out very quickly to all of our sponsors and everyone involved with this, from FTMIG, IR Inc. Thank you for our sponsors of Noble Capitals, Channel Check, Business Television, and Newsfile. We've got a lot of great presentations coming up today. After this presentation at 10:30 a.m. Eastern, every hour we're going to have a new company. Their company's going to go through a very long presentation, so we're going to get in depth. This is something that you're going to be able to really learn about this company, learn about their management team, what it is that they're doing. And then the big part about this is that after that half an hour presentation is finished from each company, we encourage you, please, we'd love to hear questions from you. The companies would love to hear questions from you. We're here to answer them. So just after this, we're going to be having Ely Gold at 10:30. We've got BlackRock Gold at 11:30, Standard Uranium at 12:30, followed by Encore at 1:30, Jaguar Mining at 2:30, and then Magna Gold at 3:30. And finally, a presentation you don't want to miss is with Taylor Tone and Ryan Irvine. They're going to be talking about all the different things that investors should be looking for when investing in the world of mining, but also investments just in general and how you should be approaching your portfolio. But without further ado, I am going to turn it over to Peter, who's our opening speaker today. Peter, I want to thank you very much for coming on here and looking very forward to hearing what you have to say.
All right, thanks. I wanted to maybe set a timer here so I have an idea when I'm supposed to stop talking.
No problem.
But although, let me see. Hold on. Timer. It's at 20 minutes. All right, I got it going.
Not to worry. I'm going to turn my camera off and give it over to you now.
All right. Well, thanks everybody for attending this event. And actually, before I start talking, I want to let everybody know that after a long process, my asset management company, Europe Pacific Asset Management, is finally approved as a registered investment advisor in Canada. So we now can take Canadian accounts. We are now managing money directly for Canadians out of my asset management company in Puerto Rico. And soon all of my mutual funds, including my gold fund, will be available to Canadian investors as well. And I think my strategies are more important now than they've ever been, because I really think we are getting to the very end, the final chapter in this book that really Alan Greenspan started to write. And I have a feeling he had a understanding of how badly it was going to end. But unfortunately, a lot of the people who have been adding pages or chapters to that book since Greenspan resigned really don't have any idea what's coming. I mean, they may have an inkling, but I don't think they're nearly as knowledgeable as Greenspan. And I think Greenspan knows that the chickens that he let loose are about to come home to roost. If you go back to the beginning, which is the Greenspan Fed, particularly during the 1990s, in the years that inflated the dot-com bubble. I mean, that was really the accumulation of the mistakes that Greenspan had made during the 1990s. And when that bubble popped, instead of admitting his mistakes, Greenspan ignored them and tried to revive the economy by inflating a bigger bubble in the real estate market than the bubble that had just popped in the stock market. And the Fed succeeded in inflating that bubble, but that was not a success. It was a failure. I was a very vocal critic during the early 2000s of the Fed, precisely because I knew that the artificially low interest rates were distorting the economy, particularly when it came to the real estate market and the lax lending standards that the Fed's policy resulted in or enabled, combined with the moral hazards of Fannie and Freddie. And I was warning on television and in my book that this would end badly, that the bubble would pop, that it would have horrific consequences, not only for the economy, but the financial system. I predicted the problems that the banks would have, the failures, the bankruptcy of Fannie Mae and Freddie Mac. I predicted that we would have the worst recession since the Great Depression, that unemployment would rise to double digits, and that budget deficits would hit 1 trillion per year. You can contrast that to all the rosy forecasts that were being made by the Fed at that time, by both Ben Bernanke as chairman and Janet Yellen, who was at the Federal Reserve Bank of San Francisco. They were extremely optimistic about the economy leading up to the 2008 financial crisis. They denied that there was a housing bubble. They vehemently denied it. And they conceded that even if they were wrong and there was a housing bubble, they thought that that bubble represented no threat to the overall economy. And that's either because they were lying or because they just didn't understand how the economy was affected by the real estate market. I knew that the bubble economy was a function of consumer spending. And where were the consumers getting that money? They were extracting it from the equity in their homes. They were using their homes as ATM machines. People were living beyond their means. Nobody was saving. Why should you? Just buy a house and then let the house appreciate and borrow out the money. So the whole economy was distorted by the malinvestments and bad decisions that were being made as a result of artificially low interest rates. Now, of course, the Fed tried to normalize interest rates, and they kind of succeeded. But by succeeding in normalizing rates, they also succeeded in bursting the housing bubble and creating the financial crisis. And it's also important to point out that even after the subprime market blew up, and I was one of the people who had advised people and who had shorted the subprime market before it collapsed, even after the subprime bubble popped, the opinion of the Fed, specifically of Ben Bernanke, was that there was nothing to worry about, that the problems in the subprime market were contained to subprime, that we didn't have to worry about it spilling over to the broader mortgage market or to the economy. And of course, I pointed out that Ben Bernanke was wrong, that the subprime was just the tip of the iceberg, that it was the mortgage market in general, the whole real estate market was going to collapse and take the economy down with it. Again, the Fed was completely wrong, and I was right. Then, when the Fed made another mistake of lowering interest rates to zero, which was an even bigger mistake than Greenspan made by lowering them to 1%, the Fed assured us this was temporary. And they also started quantitative easing. They didn't call it QE1, they just called it QE, because they didn't realize that they would have to do it again, except I did. The minute they launched QE, I said that the program would fail, and so they would repeat the program with another round. Ben Bernanke actually went to Capitol Hill and reassured Congress that the Fed was doing this one time only. It was an emergency measure. It would never be done again. And Ben Bernanke assured everybody that the Fed was not monetizing the debt, that we would never do that. This is the United States. We're not a banana republic. We don't monetize debt. He said that we are not permanently buying this debt. This is just a temporary situation. As soon as the emergency is over, the Fed is going to sell all of these bonds that it bought during the emergency. Now, I called out Bernanke real time and said, that's not true. That's never going to happen. Either Bernanke is lying or he's incompetent. The Fed is monetizing the debt. They're never going to sell these bonds. They're going to live on the balance sheet in perpetuity. Once you go down this rabbit hole, there's no turning back, that the Fed was going to be permanently financing U.S. government debt. Once again, the Fed was wrong, and I was right. Now, when they began to taper, right, after QE3, when they said, okay, we're done, we're going to normalize interest rates and shrink the balance sheet, I said that's impossible. Even if the Fed tries to normalize rates, it will fail. If it begins to shrink its balance sheet, it will never complete the process. It will immediately have to go back to QE. I alone was predicting QE4. In fact, I predicted QE infinity. The Fed said, no, we're going to normalize rates. We're going to shrink the balance sheet. It's going to be like watching paint dry. Again, everything the Federal Reserve said about their ability to normalize rates and shrink the balance sheet was wrong. I said that they were wrong as they were saying it. They never were able to normalize interest rates. They never came close to returning the balance sheet to pre-crisis levels. In the fourth quarter of 2018, the Fed abandoned the rate hikes at about 2.5%, not even close. to normal. They called off quantitative tightening. By 2019, the Fed was back to rate cuts. When they cut rates in 2019, what did the Fed say? This is a mid-course correction. Don't worry. We'll be raising rates again shortly. What did I say? I said, it's not a mid-course correction. This is the beginning. We're going back to zero. And that's exactly what happened. When the Fed first started doing QE, when the repo market blew up, they denied it was QE. I said, it's exactly QE. The Fed is lying. They're no longer lying. They've dropped the pretense. They're doing QE. It's QE infinity. Not only are interest rates at zero, but the Fed is now saying that they're going to remain there indefinitely. The Fed is now admitting to what I said was going to happen from the beginning, that it is now a permanent fixture in the bond market, that the government is now so hopelessly in debt. There are now so many bonds out there that there's no way the private sector can finance this. Therefore, the Fed is the only way to keep the bond market from imploding, to keep the U.S. government from going bankrupt. And so we are now the banana republic that Ben Bernanke assured us we would never become. But my point of going through this long list of Fed failures is to point out something that should be obvious. The Federal Reserve has never been right. Everything they have said about the efficacy of their policies, what their policies would create, and their ability to reverse them or unwind them has been wrong. And it's amazing how consistently wrong they've been. In fact, it's hard to believe that it's just a result of incompetence. Because if the Fed was incompetent, maybe just out of sheer chance, they would have got something right. The fact that they've never got anything right shows you that maybe there's more to it than just being incompetent. Maybe they are lying. Maybe they're just giving disinformation because their main goal is simply to kick the can down the road. That's all they care about. They don't care about what the damage they're doing to the economy. They just want to make sure that the consequences from that damage happen later rather than sooner, even if by delaying the day of reckoning, they make it much worse, right? Because the only effect their policy has had is on financial markets. It's been on the bubble. They've been able to push up stock prices and real estate prices and bond prices. And in fact, even Donald Trump was a critic of this as a candidate. He saw through this farce and he got elected by leveling with the American public about the Fed policy and the bubble inflation and how it was undermining the health of the real economy. He pointed to not only our large budget deficits, but our large trade deficits as a byproduct of this reckless policy. And he promised to drain the swamp and make America great again by moving away from these bubble dynamics and by bringing down the budget deficits and the trade deficits and restoring America's industrial might. Of course, when he became president, he realized that that was a daunting task and immediately gave it up and became the new champion of monetary policy and of bubble blowing. And he's now the bubble blower in chief. He has now criticized the Fed not for being too loose, but for being too tight. Donald Trump thinks 0% interest rates are too high. He wants them negative. He wants even more QE than the Fed is supplying. And the reason for this is because the problems that we have were created by the Fed. They are a product of quantitative easing and artificially low interest rates. And you can't solve the problem by compounding the problem, right? It's not going to be the hair of the dog. We're not going to sober up by drinking more alcohol. The only way to sober up as an economy is to go cold turkey on this alcohol. But nobody in government or at the Fed has the stomach for that. So they are pushing this thing to its only logical conclusion, which is what I have been warning about from the beginning. We are headed for a US dollar crisis and a sovereign debt crisis. And the magnitude of this crisis will be unlike anything that we've ever experienced, right? Because this is not just mortgages blowing up. This is the credit of the United States government. This is the risk-free asset becoming the most toxic asset on the planet. And it's not just U.S. treasuries that are going to collapse, but it's the entire U.S. dollar-denominated bond market, which is built on top of the foundation of U.S. treasuries. So treasuries go, it all goes. Corporate bonds, muni bonds, mortgages, any debt instrument that is denominated in US dollars is going to collapse. Now, of course, the Federal Reserve is going to try to prevent this from happening, because as rates were to soar, the whole house of cards that they built on the foundation of this bubble is going to implode. And so the Fed is going to do, the only thing they can do is monetize all that debt, right? To prevent interest rates from soaring on corporate bonds and muni bonds, the Fed is going to monetize those bonds. It's going to print money. So the pace of balance sheet expansion is going to accelerate. I mean, the balance sheet is already in excess of 7 trillion. It'll go to 10 trillion. It'll go to 20 trillion. The budget deficits, which topped out at 1 trillion, a little over 1 trillion after the financial crisis, are already now about 4 trillion. Who knows how much higher these budget deficits are going to soar under President Biden. But also it's the trade deficits. We just got the figures a week or two ago about August trade deficit. It was the second largest trade deficit in U.S. history, the biggest in 14 years. But if you focus just on goods, it was the largest monthly trade deficit in history. And that record is about to be broken when we get the numbers for September. So it's not just the budget deficit that's exploding, it's the trade deficit. America's trade deficits are going out of control at a time where the Federal Reserve is on autopilot at zero as far as the eye can see. This is a recipe for disaster. The bottom is going to fall or drop out of the dollar, and there will be a global run on dollars and all dollar-denominated debt. And as the Fed is forced to print money to buy up the debt, it's basically throwing gasoline on the fire, which will cause even more people to run from the dollar. And as they're running from the dollar, where are they going to run to? Right? A lot of people have a false sense of security that the dollar's days as the reserve currency are not coming to an end because they don't see a viable replacement on the horizon. And I agree. I mean, there is no other currency that should replace the dollar. It's not the euro, it's not the yen, not the Chinese RMB, but there is a logical replacement for the dollar that everybody is overlooking, and that's gold. The world is going to return to gold-backed paper money. You know, the dollar replaced gold as the primary monetary reserve for every currency on the planet. We did that in Bretton Woods. Why were we able to do that? Well, because we were the richest creditor nation in the world. We had the largest trade surpluses, and we were the biggest creditor nation. We loaned money to everybody, and everybody owed us, and we had practically all the gold. And what we did is we made with foreign central banks, instead of holding gold, just hold US dollars because they're as good as gold. They're backed by gold. You can have your gold whenever you want it. If you have $35, just come over to give you an ounce of gold. It's right there. In the meantime, you can take those dollars that you were just holding in gold and earning no interest and buy US treasuries. And now you'll get interest on your gold. It's a win-win. So the world agreed to go on the dollar standard. The minute they trusted us, we screwed them over, right? We started to print more money than we had gold to back it up. Eventually, our creditors got wise and they began demanding gold for their dollars. That led us to default on our promise, go off the gold standard in 1971. The dollar lost about 2/3 of its value against other fiat currencies. Gold soared from $35 an ounce to $800 because a dollar backed by nothing is not the same thing as a dollar backed by something. That's why oil prices went up tenfold from $3 a barrel to $30, because instead of paying for oil with gold, we started paying for oil with paper. And so the oil producing nations wanted more paper because we were no longer giving them gold. But now what's about to happen is the world is now going to finally go off the dollar standard and go back to the gold standard, because the US dollar can no longer function as the world's reserve currency. We are no longer the world's biggest creditor nation. We are the world's biggest debtor nation. In fact, we have more debt than all the other debtor nations combined. We are running horrific and unsustainable trade deficits that are now going through the roof because of COVID. Because what is the US COVID economy? Americans are not working. They're sitting at home and shopping on the internet, and they're getting checks from the government. Where's the government getting the money? From the Fed. So Americans are not producing goods. They're not providing services, but they're spending money like crazy. And so this is flooding the world with dollars. And so we are living more beyond our means than ever before. The problem isn't COVID. The problem is we were ill prepared for COVID. We had nothing saved for a rainy day, and then it poured. And now we're asking the world to bail us out. So the world not only has to deal with their COVID problem, but ours as well. It is too big a burden. The world can no longer afford to support the profligacy of the United States. And the sooner they walk away from the dollar, the better. And that is what's going to happen. And so as the dollar collapses, gold is going to take its place. And that's what we're seeing, right? Foreign central banks are buying gold. They're going to be buying more gold, but also as gold really begins to rise, which it will. I mean, the world is not going to go back on a gold standard at $2,000 gold. It may take $10,000 or $20,000 gold. I'm not really sure, but the number is going to be much higher. But one of the ways that the world's gold reserves are going to increase as a result, as a percentage of total reserves, is because of appreciation of gold. So they don't have to necessarily buy all the gold. They just have to watch the value of the gold that they already own go up. But this is a problem right now for a lot of Asian central banks that just don't own enough gold, a lot of the emerging markets. So they're going to be big buyers, and they will continue to be big buyers of gold. But this is going to be a major realignment of the global economy. The United States will no longer be able to live beyond its means by exporting the money that we print to import all the goods that everybody else produces. We're not going to be able to borrow what everybody else saves. So the whole global economy is going to be turned upside down. It's going to be a huge negative for the United States, but it's going to be a huge win for the rest of the world, which will be relieved of the burden of supporting and subsidizing the U.S. economy. So this is a major positive for the rest of the world. I've already hit my 20 minutes. How much time do I have? But no one's saying anything. But let me just wrap it up then. It's going to be a major benefit for the rest of the world because the world is now going to be able to consume what it produces and invest what it saves without having to involve the United States. And being on a sound monetary system based on gold will provide a lot of stability that is missing in the current dollar system. It will help rein in excess government spending and result in more economic freedom and prosperity around the world, hopefully eventually in the United States too. But in the meantime, it offers an incredible investment opportunity for the people who understand how this story is going to end. If you can position yourself now out of US dollars, out of US stocks, into gold and gold mining stocks, and own companies in the emerging economies that are going to benefit from the dollar's demise, that are going to see this giant weight lifted from their shoulders that will emancipate their economies. If you invest in these markets now, you have the opportunity to earn once in a lifetime profits. And I'm in a position to help you attain that goal at my company, Euro Pacific Asset Management.
Absolutely. Well, Peter, I appreciate it very much. I believe my microphone may not be working actually, but thank you very much.
No, I can hear you now.
Oh, you can? Oh, beautiful.
I hear you.
Oh, well, I appreciate that because I've been telling a lot of people I believe Keynesian theory is broken. We've completely destroyed it. There's no monetary policy whatsoever because you can't keep going lower and lower in a liquidity trap just like Japan's been the last 20 years. I studied economics in school. I have no idea where to go from this, and I don't think anyone does. So I appreciate you bringing it up, though, because that's one of the major reasons why I'm investing in precious metals is because I'm seeing it all completely explode. So I appreciate everything you had to say.
Yeah, well, you ain't seen nothing yet. Wait till you see what's about to happen.
I can only imagine. Well, Peter, I appreciate it very much. For anybody who wants to tune in more to you, where can they turn into? And then we're going to be heading over to our next webinar. But where would you like to guide them for looking more into Peter Schiff and yourself?
Well, certainly, if you want to become a client of mine, go to the website Euro Pacific Asset Management. But definitely follow me on social media. Follow me on Twitter, Facebook, Instagram, and listen to my podcast, the Peter Schiff Show podcast. I do generally 2 a week, sometimes 3 or more if the markets are really moving or there's some breaking news that I think is really important. So you can listen to that anywhere that there are podcasts, but directly on my website, schiffradio.com. You can also go to my YouTube channel, subscribe to that channel, by the way, but all of my podcasts as well as other content is posted to my YouTube channel, the Schiff Report. So go and subscribe to that channel as well. But there's a lot of misinformation that is put out every day in the mainstream media. So you want to tune that out, and you want to tune me in, because you're going to get a more honest assessment of what's actually going on, and more actual investment advice as to how to profit from it.
Absolutely. Well, Peter, once again, thank you very much. And for everyone, we're going to be ending this webinar now. We're going to be jumping over to the Ely Gold webinar. You should be automatically sent over that. But if you've registered before 8:30 this morning Eastern time, you would have got an email from our team that gives you a whole hot doc where for each individual webinar, it's got a square over it. If you click on that square, it brings you right to that webinar. So for any reason, if you need to grab a coffee, if it closed down, if it didn't send you over, there's been emailed to you, so you always know where to be and how to get there. So once again, Peter, I appreciate it and look forward to everyone seeing you over at the Ely Gold webinar as well. Take care, everyone.
Okay, bye-bye.